Hello and good morning, folks. With the kind of uncertainty observed this week, many would want to begin the day with saying, Thank God it's Friday. This is Almus Market Mornings with Shikhar Garg, and we shall dive right into the updates. ECB raised rates by 50 basis points in their policy meeting yesterday, despite the banking sector crisis or the concerns that we are observing. They also mentioned, though, that some regional lenders may be vulnerable to the tightening, but it was more interestingly observed that the US banks were rushing to borrow in their attempt to backstop the liquidity concerns. They borrowed USD 164.8 billion via discount window borrowing and the recent Fed backstop facility, making this the highest weekly borrowing, surpassing even the 2008 financial crisis period. It looks like uh, you know JK, it looks like the financial markets can't really leave the stimulus behind, and all this borrowing has in a way reversed half of the shrinkage Fed has achieved since the QT began. So, JK, what do you think? What is your view on these facilities and the stimuluses that the financial markets keep seeking?
Yeah, good morning. Yes, Shikhar, I think once again the liquidity infusion is a bit of a concern. But good point is that they are not sacrificing the inflation mandate as well. And that's what was seen when the ECB stuck to its guns by raising a policy rate by 0.5% as had been expected. And as is clear from Lagarde's statement, there is no trade-off between price stability and financial stability. And we are addressing price stability by raising rates. And separately, we are also monitoring market tensions. So that's indicating that there is some more work to do on the inflation. And it is not possible to comment at this point, as she said, on the rate path. That means she's failed to give clear forward guidance as far the rates are concerned. At the same time, ECB also forecasted lower inflation through 2023 and 24. So the central banks treating inflation and the bank's liquidity crisis as separate helps to maintain their credibility. On the other hand, a refrain from a rate hike would have sent a message of panic among policymakers and seen more sell-off in assets. So we expect Fed to also to follow a similar approach and increase 0.25% in March on March 22nd. We also expect them to be vigilant on the banking side, and any fallout for the broader economy will be watched closely. In fact, Yellen echoed Lagarde's diagnosis that controlling inflation remained a top priority. And US policymakers have had more time to digest market developments before the March 21-22 meeting, so that could build into the rate decision as well as into longer term projections for where the economy and the monetary policy is headed. The market forecasts are now seeing only one rate hike in this cycle of 25 basis points, and even then before Q3, and no more rate hikes, and possibly a rate cut towards the end of the year is how it is being seen. And the positive impact on the market was evident. In fact, we had a day of improving sentiment right from the Asian hours when Credit Suisse announced having got large funding from the Swiss National Bank, and this was followed by news that a large group of banks were infusing cash into the US lender First Republic Bank as a lifeline. So the best lifelines for the banks or any company for that matter is when other companies are interested in them and protecting them. So the banks coming in here suggest that the bleeding is possibly stopping for some time at least. As you said, there has been lot of withdrawal of liquidity from Fed, but that I think is necessary at least for the short term, because you cannot afford to have a bank failure at this point of time, which in fact will have an entire global contagion. So we did have a positive impact on the market sentiment of currencies, rates, and equities as well. And the Credit Suisse rose 20%. While First Republic, about which a lot of concerns had risen, previous day rose 9.8%. Major indices clawed back some of their previous day's losses by rising between 1 to 2%. And European shares rose 1.5% despite a hefty rate hike of 0.4% by the European Central Bank. There have been little less violence around Thursday than on Wednesday, and other recent trading sessions, but the big moves again, nonetheless, in the treasuries, 10-year rising by 11.5 BPC on the day, and it was much bigger at 27.4 BPC. Now we are actually getting used to this type of big swings in the treasuries. What used to take months to move are happening in one session, two sessions as well. And we have seen muted moves in the currencies yesterday. Good thing is, European rate hike has been taken as positive by the investors, and euro has been well supported above 1.0570. In fact, it has got a good floor at that level. And Fed expected to hike only 0.25% and possibly going for a pause. So the interest rate differential between Europe and US is getting narrower, and that supports a single currency. Of course, the other currencies were relatively less volatile, although yen moved in a bigger range because once the sentiment improved, yen rallied from below 132 to 133 half. Again, yen weakness may not continue for near term because it's also the financial year end for the Japanese investors, and there will be some repatriation pressures which will add some strength to the yen in the coming days. So expect yen to be in the range between 131 and 134 for near term. There's also news that big wage settlement is taking place in Japan, and the Japanese monetary authorities have attached a lot of importance to change in the monetary policy once the wages start rising. So we have to see how they react in the coming days. As far as the rupee is concerned, there was a lot of concern that the rupee could breach 83 on the basis of the latest events and also the stock market sell-off. But at least from the data that we have seen, there is no major outflow from the FIs in the last few days. At the same time, when no other currency has hit its previous low, it was quite speculative to think that rupee would breach 83, particularly when you know that RBI is steadfastly holding those levels. And even yesterday, right at the start, we saw PSU banks offering dollars, and then that led to other players who were holding longs also unwinding. So rupee continues to be in this range, 82 and 83. Until we see any other bout of risk aversion in the global markets, we will see the rupee going back to around 82, perhaps taking some pressure from the year-end selling that can resume in the coming days. Finally, the oil producers' concerns have risen after Brent and WTI prices have collapsed below key technical levels on fears of deep recession in the wake of fresh financial sector crisis. However, the prices have jumped after dropping to near 15-month lows, supported by reports that top producers Saudi Arabia and Russia had met to discuss the ways to enhance the market stability. So if the prices remain depressed, we cannot rule out a fresh output cut by OPEC+. This is something that we should be watching out from the Indian perspective. All in all, a big volatile week, perhaps ending on a slightly, softer note, or rather you can say a slightly sober note heading into the weekend. Thank you.
Okay, JK, and yes, volatile week, probably ending on the sober note. But what we really liked was the fact that central banks are able to compartmentalize both things separately, be the inflation concerns or the banking crisis. And yes, not sacrificing inflation in the wake of this impending banking concerns has definitely built in some sort of credibility for the central banks. And the European Central Bank continues to forecast lower inflation in the 2023 period is also some sort of a sign, as the differential between the US and the euro interest rates continue to reduce. We also observed some sort of a shift in sentiments yesterday, right from the Asian markets period. As JK mentioned, it needs to be seen whether the concerns for this banking contagion has taken a pause. And folks, I'm talking about a pause and not an end, because the concerns still continue. There is a significant amount of liquidity crunch which was observed during this week, and these are just short-term arrangements which backstop facilities have provided. On the other hand, oil producers, as JK mentioned, are having concerns with respect to the price dropping significantly after the growth concerns arriving, and there can be possible supply cuts announced by these nations. It needs to be seen whether they do it aggressively or quite early, or do they take their time in observing the action around the oil prices. All in all, we say rupee continues to trade in the range, and even though there has been some positive news on the trade deficit front, but the continuous concerns on the banking side has kept some bit of pressure on the currencies across the globe, and we are also seeing the same for our Indian currency. That's it for today, folks. We shall come back again on Monday with another round of updates. Thank you so much for listening.